Thank you very much, Jeremy, for this very, very provocative analysis. And I'm sure it certainly accomplished its goal, at least to provide a lot of food for thought. So let me now pass to hear our colleagues, and let's start with you, Christine. The floor is yours.
Thank you very much, Agustín, and good afternoon to all of you. If you wonder why I owe this intimidating privilege and pleasure to succeed such an outstanding professor, it's probably attributable to my good friend Agustín, who heard me say, no, there is no trade-off, at a press conference that took place shortly after the unfolding of financial turmoil that took place in March. So Agustín probably thought that's not a bad idea to have her talk to those issues in a very non-sophisticated way, rest assured. So I turn back to our European Central Bank strategy, where we actually agreed that price stability is a precondition to financial stability and vice versa. And having said that, of course, this is a very complex relationship, and one that when you compare it with the actual reality of things, makes you wonder whether they actually either go together, go one after the other. And when I look at what happened during the global financial crisis, which was the financial instability par excellence, it was preceded by a long period of price stability. And conversely, if you look back in the Second World War, post-Second World War years, which was a period of high price instability, it was also a period of time when there was great bank stability. And research, as beautifully demonstrated by Jeremy, is showing that price and financial stability interact over the course of time. Now, to the risk of oversimplifying, Jeremy, you ginger approaches. Thank you, Omar, for telling me what ginger is, which means that you're not too forceful and you're sort of tiptoeing about it. So essentially, what I understand from your paper is that monetary policy impacts investors' appetite, sentiment, whichever of the two you prefer, but it impacts the appetite to take risk. And putting it overly simply, loose monetary policy leads to higher risk taking, which can lead to excessive credit and subsequently asset price bubble. In turn, tight monetary policy, when you move to tight monetary policy, risk appetite diminishes, and that is propitious to financial crisis, especially if that comes on the back of those credit bubbles and the excessive credit that we saw. Now, of course, it's a lot more sophisticated than that, but boiling it down to the basic and the minimum for the purpose of what I'm trying to say, I think that's, I hope you're not too upset with me. So, the rapid global tightening of monetary policy in response to the steeply rising inflation has certainly brought back to the forefront the question of those trade-offs. Last year, you will all remember, and if I just look at the OECD countries, apologies to those who are not within the OECD yet, but OECD doubled to 9.6%, its highest level since the 80s. In 2022 only, central banks overseeing the 10 most heavily traded currencies delivered 2,700 basis points of tightening in 54 rate hikes. And that is a short glimpse of what was delivered over the last 2 years around the world, which was simply 470 rate hikes, which is an incredibly accelerated and massive movement of tightening. At the European Central Bank, we have raised our interest rates by 400 basis points in less than 12 months, which is our fastest pace ever, and that has led to a sharp increase in yields. So these adjustments have taken place after a long period of highly accommodative monetary policy to fight the low inflation that we had for far too long. So a rapidly changing environment has exposed some vulnerabilities, and that was obviously demonstrated in the course of the two major bank failures that took place in the United States, First Republic, then SVB, which were the second and third largest failure in US history in a matter of weeks, and of course the transformation of Credit Suisse into UBS that took place a few days later was an indication of how trouble in one part of the world can actually spill over to other places. But it is important to stress, and that's the line that I will take, because I think the point is to have an argument, Jeremy, you and I. But the line I would take is that there is no necessary trade-off between tightening rates and the health of the financial sectors. And I will try to demonstrate in very brief comments that institutions and policy toolkits actually matter enormously. So I will try to mention how, in respect of the euro area in particular, both factors, institutions and policy toolkits, can mitigate the concern of financial dominance. So, looking at institution first, euro area banks today benefit from solid fundamentals following substantial regulatory, yes, and institutional reforms that were implemented since the global financial crisis. Europe has applied Basel III rules to all European Union banks. That is over 2,000 of them in total. And today, the aggregated Common Equity Tier 1 ratio stands at a solid 15.3%. With the single supervisory mechanism that was established in 2014, shortly after the global financial crisis and the European sovereign debt crisis, banks today benefit from aggregate liquidity coverage and net stable funding ratios well above their minimum, respectively 61% and 26%. That's for the institutions. Looking now at the toolkits, that has evolved considerably since the global financial crisis. And we can, as a result, set the right policy stance to control inflation while using other tools to address financial stability risks. So what are those tools that we didn't have at the time of the global financial crisis? Long-term refinancing operation, asset purchases, transmission protection instruments that can all be used if needed to safeguard monetary policy transmission. And we actually revamped, on the occasion of our strategy review, our analytical framework to incorporate financial stability considerations, allowing for greater visibility on the links with monetary policy, but not with a view to mitigating our monetary policy. In other words, not to factor in financial instability, potential risk on the horizon to mitigate monetary policy, but to simply take it into consideration. But we're not complacent, and there is no ground for that. We know that financial stability outlook remains challenging, particularly in the current circumstances, and I would just mention two areas which the Governing Council of the Euro system at large has flagged. First of all, tighter financing conditions are raising banks' funding cost and the credit risk of outstanding loans. And that, together with the US tension that were observed in the banking sector, could give rise to systemic risks. Two examples of that. By 2026, rolling over senior bank bonds at current yields would nearly double the cost of bond funding and reduce aggregate sector return on equity by approximately 50 basis points a year. Second example, while our non-performing loans at the moment are at record lows, loans showing a significant increase in credit risk, so-called the Stage 2 loans, are on the rise. Second category of risk, briefly, higher borrowing costs may also amplify a downturn in the euro area property market cycle that will resonate with many of you. It's not isolated in the European Union or in the euro area, but it could certainly weigh on financial resilience. A record number of banks, even more than during the global financial crisis, have reported a decline in the demand for mortgage loans in the first quarter of 2023, and this is expected to continue in the following quarter, as indicated by their survey. Euro area commercial real estate markets remain in a clear downturn, with almost 40% fewer transactions in the fourth quarter of 2022 compared with a year earlier. So those are two examples of risks area that we are monitoring very closely. And as financing conditions continue to tighten, we will gain more insight into the resilience of euro area firms, households, and banks. And we are in the process of enhancing our risk management and our bank stress testing as well to be as comprehensive as we can. But we take the view that for the time being, inflation is actually our reality and a harsh reality to contend with, whereas financial instability remains a risk that we have to consider, a risk that we have to guard against, and a risk against which we believe that we have both a regulatory environment as well as the supervision tool, if acted upon with courage and determination, that can actually mitigate consequences of. So as a result of that, as you can imagine, the European Central Bank will do what is necessary to deliver on price stability, which means the timely return of inflation to our medium-term target of 2%. And in parallel, but not to be mingled, in parallel, targeted macro and micro-prudential policy actions, enhancement of our resolution framework, and completion of the banking union remain, in our view, the best means to further enhance the resilience of the financial system. To conclude, I'm just going to mention one area that I'm not going to discuss here because I don't have time, but I think that fiscal, and particularly the fiscal consideration that Claudio explained very clearly this morning, are to be massively taken into account, as they can be a tool to actually mitigate some of the financial stability risk that we have on the horizon, and if not coupled in close coordination and working in the same direction as monetary policy, can actually work at cross purposes. And I will finish with one thing. I have recently interviewed 3 supervisors or head of supervision who have now retired, who are safely looking after grandchildren or growing their roses. And I've asked them, I said, what is the most efficient supervision tool that you think you either have used or you would have liked to use that would be efficient to actually enforce discipline and mitigation of risks? And all 3 have said the same thing. They have said the fit and proper review. It's called different names in different countries, but it's essentially investigating whether a person, not money, not markets, not those sort of vague and loose and critically important things, but people are actually appropriate and adequate to run the kind of risks that we can all be exposed. And the second thing was the criminal liability that is associated with actually mismanaging. Just for consideration. So, thank you.
Thank you very much, Christine, for a very well-calibrated message, time-wise and content-wise. It will be very helpful for our debates. Amir, the floor is yours.
Thank you, Agustín. It's always a pleasure to follow Jeremy in his thought-provoking papers, and you took many of the conclusions that I have. I agree with you that post-GFC we are much better tooled. We always need to improve on those macroprudential measures. I would say Bob Lucas's famous monograph on business cycle argues that the value of reducing business cycles fluctuation is very small. All the action is in growth. One way to read it is that central banks are irrelevant. Another way to read it is that they've done a great job. I probably don't buy into either conclusion, but one way to read Anil or Jeremy Stein's paper is that, it's a joint paper, is that central banks may have lowered mid-range volatility, but induced tail risks by their own actions. So the paper essentially asserts there can be no separation principle between monetary policy and financial stability, and advocates that monetary policy should take that into account, and specifically proposes that was that S variable to accommodate stance in itself, and by basically a priori the central bank in particular towards the lower end shouldn't lower rates as much. So the recommendation may in itself be fine, but here comes my but. I'm not sure it follows from the evidence, nor is there a clear framework, which you yourself said, how to quantify such a policy objective. As with many important economic problems, the issue of short-run versus long-run objectives is really important, and the distinction between ex-ante and ex-post treatment really arise in this context. It is quite clear that financial crises, if they happen, create longer and lasting recessions, and I think we agree on that, and in fact adversely affect monetary policy. So ex post, once such a situation arises, like in the recent events, the separation is difficult to achieve, even though the recent events show there was ability to deal with it without actually getting into the monetary policy that explicitly. The real issue is whether one can avoid this ex ante at what cost, and that's kind of how I think of your paper. So I think first, just like Christine, you said, I think it's clear that both price stability and financial stability objectives are important. Probably lexicographically right now for us, inflation is the real thing. As Christine said, that's the objective thing. And for many central banks, officially, actually, price stability comes first. And the issue is whether adjusting or curbing monetary policy ex ante or even ex post, this is one cost, would infringe on central bank credibility meeting its inflation target as you're doing this adjustment up front. And in the paper, you said you're targeting output, but if you had inflation as a credible target in its own way, this could be a cost, and if you hurt, we know that if we hurt or damage our central bank credibility, that has an immense cost. You said at the outset there are certain things that you don't think we can quibble with, so I'll challenge that unquibbleness. I think the real question is: are crises really predictable, and are central banks smarter than financial participants? This is sort of a little bit of market efficiency kind of thing. In other words, why don't large financial institutions take positions to profit from this, the so-called predictability of crisis? It is probably, when I looked at the evidence, it is probably very weak predictability, as you said, R square of 0.2208, 0.08, spans long periods to sow those seeds, and probably there are some limits to arbitrage. So some of the evidence sort of flavors this ex post statistics, and in particular that figure 1 that you presented. The term premium just looks like a secular decline while you're seeing price earning ratios and standard cyclical movements in lending. So I'm not sure I completely buy that. The second thing is the logical argument. The logical argument here is central banks move their policy, that leads to risk premia changes, and that in turn changes the economics. There are many, many other economic models where the logic is the central bank changes its policy, that changes economics, and that gets reflected in equilibrium in risk premium. Also, one more comment about, we've had, as Christine said, the longest accommodative period since 2008. And the question is, what crisis has followed that? Yeah, there were things, but we had Ukraine, we had COVID. I'm not sure that fits into the sowing the seeds of credit bites back in the usual sense that you were doing things. And the other sample points were ones where we didn't really have large macroprudential tools. So these are different data points. All right, now let's assume we even agree that loose monetary policy, this is a debate team, let's assume this is a monetary policy induces excessive risk-taking and crisis. The framework in the paper assumes central banks are endowed with enormous knowledge of knowing when reduced risk premia are objective and represent fundamentals, and when they are biased downwards through some of these biases and will lead to excessive risk. I'm just not sure that we are that good in terms of identifying these points or these S's that were in your model, and that as a consequence, the interest rate as a broad tool is the right lever. Now, even if we were able to identify it, let's continue with the debate team, okay, these excessive risk premium points, this may lead to excessive policy movements. We know that the variance of risk premia is huge relative to the variance of output traditionally. So we could end up endowing ourselves with very excessive movements in policy rates just due to putting in these financial conditions. Finally, 2 days ago, Cochrane was, I don't know if John is here, but he claimed that without fiscal policy, central banks don't even affect inflation. This paper says central banks affect everything, including the neutral rate, which in itself is something we need to grapple with. But I think it suggests to what you are saying that to the extent that this is agenda, it needs to cover a lot more ground from a research perspective where we're going. So is the policy recommendation at the end of the day, should we cut less or should we increase rates earlier? And if anything, I think it's the latter among these things. And I think there is a distinction between the two. Just a few more points. And if you take the policy, as you say, on average, interest rate will be higher relative to a policy that doesn't take the credit bites back into account, because you won't lower as much as you would. And then the question is, what is the framework to think? What is the output cost due to that? You mentioned the leaning against the wind, and there's sort of type 1 and type 2 error. You could do all of that in order to front run and make the gains you were alluding to. But as in your last numerical example, if you have a type 2 error and you are not able to combat the crisis, you end up probably with the higher rates leaning against the wind in a situation where unemployment is higher and then the costs are a lot higher. And that needs to be, both of these things needs to be taken into an analysis. I agree with you that the leaning against the wind, Svensson and others have mentioned it in the context of exogenous shocks, but I think the intuition is the same intuition as here. So if one is not to adjust monetary policy ex ante, what is there to do? And this is where I agree with Christine. I think that we need to resort to these macroprudential, and you yourself agree with that, Jeremy. It's just a question of weights. The real question or your criticism about macroprudential, are we solving yesterday's war or yesterday's problem? We always identify it, and I think there's an element of true of an arm race there as technology change, non-bank financing arrives in a bigger way. It is the first line of defense. The hard part is to identify new risks, and new technologies bring about some new risks, as well as they interact with non-bank credit, and that creates regulatory arbitrage. But I would allude to what Agustín said this morning and Claudio. Basically, this is the first line of defense. It needs to be strengthened. We need to tighten macroprudential measures and fix all these gaps. It's hard work. And add that well-developed resolution protocols and tools to the event that ex post you find yourself in such a situation. I would say if you do think that there are these biases, such as reaching the yields or other things, you may want to go and figure out ways to avert these things ex ante. For example, severe clawbacks on investment houses and the way they're compensated, so you don't get into these things. So to sum up, probably a complete separation doesn't exist, especially ex post. I agree with that. Probably we should strive to better understand about how these risks develop. I think we need to push much harder on these macro prudential, how to make them more effective, and develop better resolution and other tools to deal with crisis management when it arises. Thank you.
Well, thank you very much, Amir, for your quibbleiness. And now, last but not least, John Williams. Please, John, the floor is yours.
Great. Thank you, Agustín. It's a pleasure to discuss this important topic with this distinguished group of scholars and policymakers. I only wish I could have joined you in person. Now, following the excellent presentations by Christine and Amir, which I agree with, I will keep my remarks concise, which is admittedly the most dreaded words at central bank meetings. 9 years ago, I gave a speech entitled Financial Stability and Monetary Policy, Happy Marriage or Untenable Union? I admit to having held a pessimistic view of the prospects for this match. I ended by saying, and I quote, to sum up, we are all aware of the importance of having a robust, resilient financial system, and recent events have made that all too clear. The challenge for economists and policymakers is to better understand the sources of these risks and the tools that can be devised to reduce them without undermining the hard-fought achievement of price stability and well-anchored inflation expectations. And the experience of the past 9 years has only reinforced this conclusion, and I could just stop there. Instead, I'll use my allotted time to focus on really what I think of as the flip side of some of the questions that Jeremy discussed in his presentation. And that is, what are the costs of using monetary policy to address potential financial stability vulnerabilities? And Jeremy mentioned some of these in his remarks, but I'll highlight 3 issues that I think are particularly relevant. First is the anchoring of inflation expectations. Second, the evidence on the link between monetary policy and financial stability vulnerabilities. And third, the trade-off between monetary policy and financial stability goals. In the current environment of high global inflation, central banks around the world have been taking strong, decisive actions to restore price stability. And restoring price stability is of a paramount importance because it is the foundation of sustained economic and financial stability. Price stability is not an either or, it's a must-have. And that's not just true today, it's universal. So it's essential that monetary policy can freely use its tools to achieve price stability and securely anchor inflation expectations. I think this applies equally to situations where the appropriate stance of policy is accommodative, which is often what's discussed in both by Jeremy and others, and when it's restrictive, as Christine talked about. A glimpse of the trade-off between perceived financial stability goals and price stability can be seen in the experiences of Sweden and Norway in the middle of the last decade. The central banks highlighted financial stability concerns over achieving their inflation targets, and we saw measures of a long-run inflation expectations fall below levels consistent with the target. Now, there is a view held by some that an erosion of well-anchored inflation expectations below the target is not such a big deal, and I disagree. Below target inflation expectations, like lower R*, diminishes the policy space to respond to negative shocks. That results in worse macroeconomic outcomes, even lower expected inflation, and the need for even stronger use of what used to be called unconventional policy tools. And the experience of Japan is a reminder of where that road leads. More generally, credibility that's conditional is not sustainable. You either are committed to your goal or you're not. Second, it's not clear that monetary policy actions play a central role in affecting the emergence of financial stability vulnerabilities. To be fair, Jeremy asked us to take this part of his story with a grain of salt, and on that point, I wholeheartedly agree and will reinforce that message. A recent literature review on this topic concluded, and I quote, while there is some evidence that monetary policy affects asset valuations, investor risk appetite, and household leverage, these are exactly the things that Jeremy said or kind of generally agreed. To date, the empirical evidence does not point to quantitatively meaningful implications for financial vulnerabilities and the real economy. Indeed, there are other far more important drivers of financial stability vulnerabilities that we should be focused on. I'll give an example. Jeremy quickly showed a chart in his presentation, which showed the, I think it was the equity price to earnings ratio in the United States, and you saw the run up in equity prices in the late 90s, when real rates were actually relatively high. Of course, we saw a similar thing further back in the past in Japan during their bubble much earlier. Now, the weak link between monetary policy and financial stability is also seen in the evidence, or lack thereof, of the negative effects of crises on real interest rates. The narrative that estimates of R* are driven lower by financial crises is simply not borne out by the data. Thomas Laubach and I looked at this some years ago, and if anything, we found that short-run real rates tend to be somewhat higher following crises, and this is based on the Jordan Shulrick-Taylor data set. Similarly, stock flow dynamics of the kind studied by Johannes Wieland and others may affect short-run estimates of R*, but cannot explain the trend declines in long-run estimates of R* seen in many countries. and documented my work with Catherine Holstrom and Thomas Laubach and confirmed in our latest estimates. Finally, let me turn to the hypothetical question to Don Cohn that Jeremy ended his talk with. The question, or my version of the question, is what would it cost in terms of macroeconomic goals if you used monetary policy to counteract the house price boom that we saw between 2000 and 2006? So let me put some numbers to this based on a large literature on the effects of monetary policy on house prices in the economy. Now, empirical estimates differ, but a typical estimate in the literature is that an increase in the short-term interest rate that lowers house prices by 4% also lowers real GDP per capita by about 1%. Now, that is a very unfavorable trade-off. And of course, it doesn't include the effect on inflation. So based on this estimate, using monetary policy to reduce house prices, say, by 25%, would actually create a larger fall in GDP per capita than occurred in the United States during the global financial crisis. Now, Laura Svensson and Jorda, Scholrich, and Taylor also conducted related exercises and found similar results. The cost in terms of lost output from using monetary policy to address potential financial stability vulnerabilities is very high. Now, there's been a great deal of research that has advanced our understanding of the nexus between monetary policy, the financial system, and the economy, and Jeremy did a great job of describing that research and what we've learned from that. But still, despite this progress, I think we still have the same challenge that I talked about 9 years ago. We need to continue to better understand the sources of financial stability vulnerabilities. And importantly, and this gets to the comments by Christine and Amir, we need to understand better the tools that can be devised to reduce them so that monetary policy doesn't have that burden. And of course, importantly, we don't undermine the hard-fought achievement of price stability and well-anchored inflation expectations, which I think is the root of price stability, macroeconomic, and financial stability. Thank you.
Well, thank you very much, John, for this very complete commentary. Jeremy, you can clearly see that
everybody agrees.
Yeah,
I have nothing to say.
That you have some argumentative headwinds. So now it's your turn to push back.
All right. Well, thanks to all of you for the terrific comments. Christine, I'm sorry to disappoint on the argument front. In the current moment, I agree with you 100%. 100%. I think there's no sense at all in which you should be backing off on the inflation thing. I think there's no tension. I mean, I think there's no tension over the goal. Of course, if there's a drag on credit, you need to factor that in. But that doesn't mean in any way giving up the goal. 100% agree. And I think I should have been clearer on this. This is what I meant sort of towards the end of the talk when I said it really depends where you are. In the same way that when you're at 8% unemployment, that becomes, to use Amir's thing, that becomes lexicographically the thing to deal with. Right now, inflation is so far from target, that has to be the dominant thing. 100% agree, and give you and your colleagues in other central banks all credit in the world for being both right and courageous on that. Okay, so but again, to maybe argue a little bit with John, that is because it's not that I think that is an absolute principle that applies always. It is a principle that applies in the moment, given the urgency. I think where I differ with John is, again, if inflation is resolutely and stably at 1.7 for a bunch of years, and the Phillips curve is very flat, and you tell me it's going to take 100 basis points or more of easing, and financial conditions are already very easy, I would say, you know what, I accept the 1.7. Okay, so I just think that this is a framework that ultimately needs to be thought about quantitatively, but all my instincts are 100% with you guys in terms of the magnitudes are going to shake out such that you're going to be 100% or 99% right now, and then John and I are going to have a disagreement around 1.7 versus 2. So that was, I think, the most important. And I'm always at risk of understating my attachment to the importance of the macroprudential stuff that people are doing and continue to do? Of course. I mean, I think it's incredibly important. And by the way, I think it varies by jurisdiction. I think in some ways, Europe has done a better job. And I think the political economy environment, my experience in the US, is particularly unfriendly to some very sensible things, countercyclical capital buffer, other things that I think we would all agree you want to do. But you also have to take the world as it is, and if you find yourself in an environment where just more and more stuff is leaking out to capital markets where they're not regulated, agree with you, if you could, claw back hedge fund managers, but you have to deal with the world that is handed to you. All right, so I think there's more agreement there. So let's see, Amir. Also agree with you on a bunch of stuff. Again, the lexicographic, we agree in this case. On the quibbling, again, I should have been clear. I think where there was less quibbling is on the high-frequency event study stuff. I don't think we're going to disagree too much that a monetary policy innovation does something to term premia. I think you're right to quibble with the longer horizon stuff about are crises predictable. And I think, again, you said it just right. The evidence is that they are statistically predictable, but like, is there a lot of economic significance there, enough economic significance? I think that's an open question. You raised the question of timing. I think this is super important. I think if we do this, if you are ever to go down this road, you're going to have to be willing to go down a road where if you're going to have this affect your policy at all, it's going to be relatively early. In other words, I think what we can all agree is once the bubble is really kind of fully blown, that's not the time to tighten, and then you're just going to make things worse. So if you're ever going to do something, the reason I sort of had the Don Cohn example is this was 2004, before things really got out of hand. Some excellent work by one of our PhD students kind of says, if you're going to do anything early on, if you're going to do anything, you want to do it early on. House prices were probably going up for pretty much rational reasons. So we're not sort of making a rational error. They're probably going for mostly rational reasons early on because rates were being cut. But that put in play, arguably, a sort of extrapolative dynamic that then created problems for us further down the road. So I think if there was, I'll say something sort of delicate, if to the extent that there was a time to intervene, it would have, not intervene, but to change the stance of policy, it would have been earlier rather than later. The one place I push back a little bit harder is this question that I feel like is a bit of a red herring, which is the central bank smarter than a hedge fund? No, of course not. But that's not relevant. That's not relevant. Of course, a hedge, good luck to you betting on the credit cycle. I'm not saying the Sharpe ratio is very high on that. And if you're a hedge fund and if it goes against you for a couple of quarters, you're dead. Okay, the central bank's incentives are wholly different. And by the way, they do exactly what I'm recommending. So I had a undergraduate student who had a very, very good thesis. If you look at the Fed, and you look at their actual policy, and you just run a Taylor rule, and you insert the Teal book forecast, so the best forecasts, and you ask, when do they deviate from sort of the Taylor rule? The best predictor of it is my measure of credit market sentiment. So when credit spreads are narrow, and high yield issuance is high, the Fed tends to be tighter than it otherwise would be. And conversely, when credit is tight, they tend to be easier, taking into account the best possible Teal book forecast. So they're already doing this, and of course it makes sense to take into account financial conditions. And I think all I'm saying really is you take those same variables, but let's think as systematically as possible about how much weight to put on them. They're putting a non-zero weight now, and they're suggesting you want to have a model that disciplines. So there is some intuition already along these lines. I'm not thinking there's a magic variable that's much different than credit spreads or some aggregate of credit conditions, but that's going to come into the policy reaction function, and I think it's going to come in with a weight as Christine suggests, now it'll only come in with a weight. Tell me how much this is going to affect inflation today. That's all it's really asking. At other times, it might come in with a weight that also has an element of what is this going to do to the economy in the future. So I think, again, in practice, to make this operational would not really represent much of a change at all in the way that it's just being a bit more explicit about when right now they're doing this, but there's really no it's not what you would expect them to be doing, given kind of the theories. They're sort of winging it, I guess. So I'm just saying, let's try to have a little bit more analysis around that. That's probably all I have for now. So let's take some questions.
Thank you very much. Any of you, Christine, Amir, John, would you like to say something?
No, I just want to add one thing, two things actually. One, I hear you say that in 2004 it was perfectly rational to expect what was coming up.
No.
No, okay.
Okay, no.
On the housing prices, huh?
I was just saying, you might think that house prices had not yet gotten to a level that was irrational in 2004 because interest rates had moved a lot, and that's a fundamental determinant of house prices. But even if they were rational at that point, the fact that they increased a lot from 2002 to 2004 can set in place a sort of dynamic that then leads to the erosion of credit standards going forward.
Okay, got it. The second point that I just want to say, it's very good that more research and more work should go into this, because given the adversity that we are facing, that you agree with me, should be the key component that we're looking at.
Yeah.
And the fact that credibility is on the line and has to be really defended, it's good that research will take a bit of time.
John, the floor is yours, and then Amir.
Okay, thanks. I just want to respond to Jeremy's comment about the quibble of 1.7 to 2. It's not about 1.7 to 2. The 1.7 was after we did all of our accommodative policy, both in terms of rates, forward guidance, and QE, got inflation to 1.7. So I think the right way to think about this is if you have an asymmetric commitment to your target, or you can't respond to negative shocks as much, then every time you get negative shocks, it's going to tend to move inflation expectations lower. And so, as worked with Thomas Mertens and I years ago, you show that in equilibrium you could easily have an inflation expectations anchored way below your target. So it's not a 1.7 versus 2. That's the data we had at the time. I also just want to agree with you on one point about the housing market. 2004, I don't know whether that was too late or early enough, but definitely if you look, by 2005, house prices were way above equilibrium. But also, I think that this point about extrapolative expectations and about how dynamics in markets can shift their patterns is something that we should really be taking seriously as we analyze how financial markets and the economy behave.
Amir, please.
On the one hand, first of all, Jeremy, this was very interesting as usual, and in some sense you are saying, and I think you are right, in some neural network, many of the central banks are sort of doing some elements of that in their minds. As you said, there are even time-varying weights now you've added to this formula, but I do think, going back to John, that 1.7 or what I was talking about, the credibility of the central bank, if you put that up front, you are changing the distribution of beliefs about what's going on, and that could have a huge cost in terms of the credibility. At the end there, you sort of alluded to a point that I was asking, is not going far enough equivalent to taking rates back up early? And I said, I think you want to have the full distribution, and you gotta identify going early fast enough.
Let me, before I open the floor, ask you a question that builds on a comment that made Christine at the end of her presentation. And as you saw in our presentation of our annual economic report, we dwell a lot on the importance of bringing to this environment, to this debate, fiscal policy. So just how do you think it would be important to introduce fiscal policy to your framework, and how would you do it?
Absolutely. I think so. It's a really good question. I'm sorry I didn't mention it before. So I have been taking, sort of throughout this whole conversation, fiscal policy is kind of exogenous. And then I think the central bank often has a tougher a tougher problem, right? Because if that's the only tool you have, sometimes the only way you're going to get there is with sort of very, very low interest rates and then some of the financial stability problems that are associated with that. And it would be a better world if, if in the period kind of before the pandemic, there was at that point stronger fiscal, because then we could be in equilibrium with a higher level of rates and presumably less risk taking. Right? I think that's clearly right. So once we expand the palette, but in some sense that is a different way of making the point, right? Which is saying with two tools, this is sort of a different version of the Tinbergen principle. With two tools, we have a better shot of getting both kind of to their targets and preserving financial stability. But if unfortunately Congress doesn't cooperate and you've got one tool, then you're like never going to hit two targets, and there's going to be trade-offs. So that's really, at some basic level, all I'm saying is there are trade-offs. And if you insist on absolutely hitting one target and not paying any attention to the other, probably at least we're sort of agreeing that that can't be really the optimal thing. The fact that you're introducing another tool to solve the problem kind of tells us that with one tool, we're in an imperfect world.
Absolutely.
And then you do second best stuff.
I think you will agree with me that Jeremy gave us tremendous food for thought. I think our exchange was very good. I thank very much the panelists. So let me ask you to join me in giving a round of applause to Jeremy.